Okay, welcome everyone. We're happy that you could join us for this webinar today. We're excited to bring the new rule, SEC Rule 13F2. Are you ready? So today, my name is Paul Murdoch. I'm with MCG Consulting Services. We have three dynamic speakers with you today, and we're so excited to be bringing you this webinar. So we will start by just giving some quick introductions. We have Robin Shulman, who's with MCG. She will be one of our speakers today. As you can see, we have the bios there, and you can read it at your pleasure. We're also excited to have Dan Viola, who's with Seward Kessel, and he will be our legal authority and explaining the rule in details along with Robin. And we have Anna Monteiro, who is with Artius Global, who has a product that will help facilitate filings. So with that being said, welcome panelists, welcome everyone to this webinar. Let's kick it off.
Well, thanks, Paul. I'm glad to be here, and I think it's a very timely webinar because there is a lot going on with this new reporting rule. About a year ago, October 13, 2023, the SEC adopted the new rule 13F-2 and the related form SHO under the Securities and Exchange Act of 1934. And they did this to promote transparency regarding the short sales of equity securities. And they identified certain thresholds that they thought were relevant and important to the marketplace. And they took a very broad approach to who needed to report and what was in the scope of an equity security. So, for example, they defined this institutional investment manager concept, which a lot of people relate to the current Form 13F reporting requirements for long positions. But an institutional manager that reports on a 13F, while that manager would be included within the scope of the manager that would need to report under 13F-2, it's not just the 13F reporters. So if you happen to be involved with a lot of short positions, you could be subject to this new Form SHO reporting regime. And even if you're not in the US, you're still subject to the requirements. If you're registered or not registered as an investment advisor, you're still subject to those requirements. So it's a very broad-based approach. Some clients have called up and said, what if we share discretion with respect to a particular short position? And the SEC addresses that particular instruction. And they say you have to just have one manager report, but you have to disclose who the other managers are that also share the discretion. And then the other issue that's kind of sensitive here, like the 13F reporting, where the SEC actually publicly discloses the managers that are actually long those positions. And under the current regime, the Form 13F-2 regime, Form SHO will not be available on a public basis for the managers. So if I'm a short selling manager, you're not going to see my name associated with the position. But the SEC will, about 3 months after the first reporting filing, they will start publishing all the short sale data through their CAT system, or the Consolidated Audit Trail system. I think that's the system they're going to use, but they're going to make it available to the public, but it's not going to be on a manager to manager basis. So those are some kind of key concepts. And the first filing will be due in on or before February 14th, 2025. So there's a bit of a time crunch here. And one of the goals of our webinar is to promote that you do stay ready, review these, requirements, and come up with a solution to meet these monthly filing reports. So if we go to the next slide. On this slide, we try to describe the reporting thresholds that a manager would need to evaluate to determine whether they have to actually file a Form SHO. And there are two thresholds, and I think, Robin, you can maybe address those requirements.
Well, right. Yeah. Where the basic
Well, I can start. Yeah.
Yeah, you're gonna have to go. I can't hear.
Okay. I can start with the thresholds.
I have an audio issue.
Okay, no problem. I can start with the thresholds to describe it a little bit.
But you guys ever need anything to reach out?
So there's two thresholds, threshold A and threshold B. And threshold A relates to any registered reporting company or a company that is actually making filings pursuant to section 12 or section 15D of the Exchange Act. So this is very similar to the threshold that the 13F filer will have to deal with. You know, there's a published list, there are reporting companies, and you know, it's quite easy to kind of determine what to report. But the difference is that under this requirement, you have two thresholds. It's the reporting companies and the companies that are not reporting companies. So you have to kind of go deeper into your analysis of your portfolio. You have to look at everything that may be a private company and might be a company that only trades on non-US exchanges. It really, the SEC took the approach that they want to take a deep dive and a broad, expansive approach to the thresholds. The good news is, under both thresholds, you don't have to take into account the exposure to your derivatives, like a securities-based swap. You don't have to take into account your fixed income positions. This is only for equity securities. You do have to take into account ETFs, but you don't have to take into account the short positions that the basket of ETFs have in their portfolio. So those are some carve-outs, and we'll get into that in a little bit more detail. But if you're in a position where you're shorting and your gross average short position is $10 million in US or more of reporting companies on the basis of a trading date calculation, which is within regular trading hours between 9:30 and 4 Eastern, or if your average gross short positions on a trading day basis as a percentage of shares outstanding is 2.5% or more, you're caught by the rule. And then if you're caught by the rule, you do have to account for other types of derivative trading in your portfolio. So let's say, for example, you own options and they are going to be exercised, and that will impact your reporting requirements. So you have to, first determine if you're within the thresholds, and then determine how you're going to calculate your gross short positions. If it's not a reporting company under threshold B, you're just going to take the gross short position on a settlement date basis, where the value is 500,000 or more US on any settlement date during the month. So those are sort of the breakdown of those thresholds. The SEC has a prescribed sort of template form that they described in their release that shows what kind of information you're going to have to obtain from those issuers. I thought some interesting information that was you have to obtain the legal identity identifiers, and they can't be lapsed. And you also have to indicate for the manager what your LEI is, and it can't be lapsed. You also have to track down the financial instrument global identifiers for the issuers, the Fiji they call it. So those are some pieces of information that you'll have to track down. Interestingly, that the template form has not come out yet in Excel or XML for the Edgar filing. So we're still waiting for the SEC for that, but we anticipate that that's going to come out soon, and it's going to mirror what was in the actual release, the tables that are in there. There's two tables and a cover page. So we know what they look like, but we just haven't got a workable form yet. So if we go to the next slide, we kind of talk a little bit more about what's in scope for the security.
Yeah, and I can take it if
Okay.
you want. I can take it from here.
Perfect.
So,
Okay, thanks, Robin.
I had a little technical difficulty. Sorry about that. Both global common and preferred stocks traded on a national exchange or over-the-counter convertibles, such as convertible bonds, ETFs that trade on an exchange, ADRs or ADSs. So if it's a foreign company, but it's traded on a US exchange, that is also in scope, and warrants and rights that give you the right to purchase. Options, fortunately, are not in scope. So, so warrants and rights, but not options. So short sales of other equities, such as privately held companies and companies traded outside the US, must be taken into account if the reporting thresholds on the previous screen are met. And if so, then you have to include them. Two exceptions to the reporting of these two thresholds, A and B, on the previous slide. Any short position you hold through derivatives, options, would not be counted towards these thresholds, and investors that are short in ETF would not need to include the underlying securities of the ETF in their positions when calculating the threshold, if you haven't met it.
Yeah, I mean, I think the important takeaway here is, start trying to calculate your gross short position according to these thresholds. Look at, a broad scope of all your positions. If you were a manager and you're going to basically say, look, I'm below the thresholds, so I don't have to report on a monthly basis on Form SHO, you're going to have to come up with the conclusion now that operationally you can show that calculation. And it has to account for non-US securities, listed securities, over-the-counter securities, ADRs, ETFs, but you do exclude the underlying trading or the underlying positions in the basket of the ETFs, and you can't exclude any, security-based swap, exposure and options. But, if you do meet the threshold, you're going to have to account for the activity in the options and how that impacts your short position. So, for example, if you're a manager that says, I'm just going to do security-based swaps, and I'll have a lot of exposure with security-based swaps of my shorts, therefore I won't have to file on a monthly basis. The SEC addressed that in their comments, and they said, look, we understand that that could happen, but there's also reporting requirements for security-based swaps separately from the Form SHO. So that, if you're trying to, maybe circumvent with the swaps or other derivatives, you still might get captured under other reporting requirements. But those are just some things to think about. Let's, start to take a look at how you can calculate that exposure. It's a monthly filing. If you, don't have a good option, operational methodology to computing these thresholds, you could get caught by a violation.
Hey, Dan, what about an ETF on a single security?
So if it's an ETF on a single security, that is, the ETF is subject to the threshold reporting. And I guess if the underlying security, that single security in the basket here would just be short, you would just the manager would just take into account their short position in that ETF, not double count with the exposure.
Got it. Thanks.
Sure. I think we can go to the next slide. And on this slide, we just tried to break down really some of the mechanics of the form. The cover page is about the manager. And then the part 2A and part 2B are the two separate tables that talk about, your gross short positions and then the net change from the month on the separate table. So it's not a very, it's not a lot of information. I think there's like maybe 8 columns in 2A and 7 columns in 2B. And, it's the issuer's name, the QSIP number, a lot of basic things. But, it makes sense to try to populate a table now so you can really, have this sort of streamlined into your trading systems.
Hey, Dan, I have a couple questions from the audience that I think are appropriate to ask right now. One question is, how will SEC sanction managers that fail to comply? Do you have any thoughts around that?
Yeah, so I mean, this is a new rule. So the way the SEC typically takes, enforcement action over rule violations is to, collect information and then proceed to see if there's going to be any civil penalties that they would sanction or maybe censures. By analogy, last month, September 17th, 2024, the SEC took an enforcement action against 11 institutional managers for failing to report their long security holdings. And 9 of those 11 firms paid in a combined amount about 3.5 million in civil penalties. And a couple of those firms also failed to file their large trader information under Rule 13H. So, by analogy, Paul, I think that, we're going to see similar actions for Form, SHO if there's a failure to report or if there's an inaccurate filing. I think that maybe for the first year or two, the SEC is going to collect a lot of the information and do tests on how much, information they're receiving. I don't anticipate a lot of enforcement actions, within the first year, just because I think the SEC still has to, get their arms around what people are doing. But I see the sanctions, being analogous to those 13F cases.
Yeah, so typical kind of what you're saying is the SEC typical protocol around new rules and kind of how they look for violations where they're giving the industry an opportunity to get their hands around it and so forth. So so given that, what should managers do if it needs to amend Form SHO filing?
Yeah, so that's a really important point. So there's a whole section of the rule that talks about amendments. So if you make an error on the filing, the SEC wants you to identify, once you identify the error, you have 10 calendar days to amend the form. And you also have to restate prior filings, going back at a maximum of 12 months. So you have to go back at least 12 months if you made an error, and that error is carried over on prior filings. And you have to file, do your amendment and restated Form SHOs within 10 calendar days. So it's a short time frame, and it requires firms to be prompt with not just the amendments of mistakes, but the reinstatement of prior filings.
Okay, and one final question related to this. So is Form SHO currently available through Edgar?
So to my knowledge, it's not available yet, and a lot of people are looking for it. So that could be another issue that creates a little bit of time crunch for firms. I don't know if anybody else has heard anything more recent, but I think it's still being in waiting.
Okay. So I mean, there's kind of an urgency of now to if managers have not been thinking about the new rule, to really start thinking about that, right? But given that, I mean, I haven't seen anything out there about any possible delays to the deadline. Have you guys seen anything or heard anything out there, or we should assume that January 2nd is a hard date?
I think you got to assume it's a hard date, January 2nd, 2025. You got to basically have your January gross short position, calculated. You have to be able to, be responsible and getting that first report done by on or before February 14th, 2025. So I think the time is now to prepare. If you've got long and short positions in a combined book, you're allowed to sort of net out those long and shorts to get your gross short, just like in a Reg SHO calculations require. But there's a lot of nuances, and I think, you depending on your positions and how you account for them, some people may not necessarily have all of their non-exchange traded positions in the same operational trading system. And because of that, you're going to have to sort of patch together all your holdings. Whereas like a 13F report with long positions, it's a little easier. You got a trading system that incorporates everything perhaps. It even gives you like a draft form. So those are the things you really have to start thinking about. If you're a market maker and you use a bona fide hedging mechanism for under Reg Show, the new consolidated audit trail system is going to have changes for you to kind of make sure that you are doing bona fide market making. That's another kind of theme in the SEC's release. And the major theme is to promote transparency of all short positions.
Great. Robin, anything you want to add to what Dan just said? I know he covered it pretty thoroughly, but
Right. Yeah, no, you did. Thanks, Dan. Just, firms might want to think about how they're going to set up their methodology of determining, which positions they own are within the rule, and then within the thresholds, and potentially put some triggers in place in some of the systems to where you might be approaching that threshold, so that you could kind of watch out and have a better understanding before the end of the month as to where your short positions that meet the threshold lie. That would be my recommendation.
Yeah, I mean, if you're a manager with a private fund, and you track your positions accordingly, you still have to look at your separately managed accounts. If you have separately managed accounts that you have discretion over. So there's a lot of nuances here, and it really requires a lot of discussion between compliance and operational staff to make sure you're in line with these requirements.
Right. I mean, as a former compliance officer, CCO, you might, if you have a guideline monitoring system, you might want to add this. You might want to add this as a soft restriction in your compliance monitoring system, so that you're aware of approaching this limit, and it may change a strategy here or there, or you'll at least know where you have to file for. So
I think the next slide is going to be more for Anna, and she's going to help us better understand, I think, an operational solution for this.
Thanks, Dan. So we're going to look at the challenges that come with meeting the requirement from an implementation perspective. And these aren't specific challenges to 13F2, really. I mean, these are challenges that go to any rule that you need to meet a filing requirement. So, we're going to cover the scope and timelines. Dan and Robin did a good job of that. The data availability, not only your data, but market data, making the calculations and the submission format. So we'll drill down on each of these. As I said, the scope and compliance timelines have really been covered by Dan and Robin. My only highlight here is really the ability for your organization to respond to amendments that might come in the future, right? So with any given rule, there is the, chance that we haven't quite gotten it right, and there are some tweaks to the rule down the road. And if you have an in-house solution or a manual process, you're going to have to adapt in a timely fashion to meet that that changed requirement. And then with data, it's really about how good is your in-house data. But more importantly, with this rule specifically, there's your ability to identify if your positions and issuers fall into bucket A or bucket B in terms of the thresholds. And that's really going to require some lifting, right? You're going to need to know, go out to the SEC database, cross-reference your issuers to see if they fall in threshold or A or threshold B. Certainly you can get licensed to third-party data to help with that, as opposed to trying to do that heavy lift yourself. And then, of course, there's the calculations, right? This isn't a simple calculation in terms of there's two different calculations you need to consider you know, whether it's trade date, settlement date. So, you know, each threshold has a different calculation, and you're going to have to be able to do that on a repeated basis. And that really lends itself to some automation. And then the submission format, as Dan highlighted, the form show is going to be the foundation for the 13F-2, but that template for the specific need of 13F2 has not been released yet and will not be released until mid-November, from what we understand. And then you have the ability to, or you have to have the capability to convert that form into an XML submission for Edgar. And that's always been complex for a lot of organizations, particularly small organizations. And there are some third parties that do that, but then you have to deal with your transmission to the third party to convert it. So it adds another level of complexity into an already burdensome process to try and appropriately meet the obligations and categorizing those buckets for threshold A and B of those issuers. And then, of course, if they don't fall in either bucket, to omit those. So you're going to need to be able to do all of that, and towards the end of the year, when there are many other factors going on within the organization. Artius Global has a global shareholding disclosure solution, and that covers over 100 jurisdictions. But we also offer the 13F-2 solution as a standalone module. So you could automate your need for satisfying the 13F-2 with just this module. This slide really highlights what we do. We take in your position and reference data, and then we will take in your market data and your 13F-2 data, right? So that identifying information coming from a third-party vendor that you might use or your own research. And then we take that in, we do some data validation to identify whether it's a new position, new issuer, a new account. We do the aggregation and segregation of the thresholds into A and B. We recognize things that are out of scope, and then we run that through our rule engine and come up with a submission-ready form, and also with the XML output. So we'll create that form on screen in the interface. You'll be able to review the information that's provided, and then you would be able to take the converted XML and be able to upload that to Edgar directly. So the value proposition really here is that we're doing all that heavy lifting for you, taking the third-party data or your own research, identifying which issuers are in what bucket. We'll do the calculation both on the trade date and the settlement date for each of those thresholds requirements. We'll also be able to provide you with an alert for approaching thresholds. There are some actual analytics in the system which were released through Power BI, which actually graph the issuer, how the issuer that you may have been holding the position goes up and down below the threshold. And each of those are reportable instances that you need to capture on your form for that month-end submission. This slide really just highlights the complexities that we're addressing, many of which I've stated. There's obviously disparate sources of data that we need to account for. Not all data is good data, so we work with what you have. We will aggregate your positions and holdings against your legal entity structure to identify where the reporting requirement happens. We will do the calculations for you, not only to provide you an alert, but also to provide that XML output for submission to Edgar, right? And as Dan and Robin have stated, there are a short turnaround. We don't get the technical specs for form show until mid-November. And then we don't have the actual Edgar Filer development release until towards the end of December, all to meet the January 2nd date. This is a bit of a checklist that we put together to help you know what you need to do, whether you're going to use a spreadsheet solution or an in-house solution or a third-party automated solution such as ours. You really need to spend the month of November setting up your data, understanding what data you have, what is missing data, and obviously the 13F2 cross-reference data to the Edgar databases to identify those reporting and non-reporting issuers. And then you really want to spend the month of December understanding the technical specification that came out, updating your data to meet that qualification, whether or not you're using in-house research or a data source for the 13F2 from a third party, being able to make sure that you can appropriately test for threshold A and B and those that are not applicable, and then being able to do those calculations for the thresholds on the trade date or the settlement date. And then you really have a month to go live with your solution, testing it over, making sure that it's a repeatable process, that it's reliable, that you are including the right issuers into the right buckets, and that you can generate form show and in an XML format for that first submission before February 14th.
Yeah, I think in April of 2025, that's when the SEC is going to start publishing the aggregated short sale related data, and that they claim to be, collecting. But again, not describing the managers, just the aggregated short sale related data. So if you're short, XYZ stock, you're theoretically can see, that, whatever other short exposure out there from this separate reporting on an aggregated basis.
Yeah, Dan, one thing about that I haven't really looked into too deeply, are they going to, let's say that you've got several managers shorting IBM, are they going to aggregate those positions into one number and publish that, or is it going to be like 3 different line items for each manager being anonymous? Do we know?
I think it's aggregated, not by manager. So it's just going to be one number. I think a lot of managers were very concerned, and comments, came about, to try to make sure that, this short sale information was not necessarily disclosed, because, an issuer may not be so friendly to a short seller in general. So, if the management team is talking to investors and they know a particular short seller is, really shorting their stock, it might chill the information they give to the short seller. So they were very aware that the SEC was very aware that this could create a problem. So I think they're not going to do anything that would indicate any type of reverse engineering where they can figure out, how many short sellers there are or who they are. So I think it's aggregated.
Right. Okay. Thanks.
Mm-hmm.
I have a couple of questions that came in through the chat. Dan, I'll start with you. And this is for a UK based manager. The UK asset manager short selling US issued ADRs transactions under the London Stock Exchange. Is this open to 13F2 disclosure reporting?
Yes. So in other words, that's a situation where it's a non-US manager, and they're within the scope of SHO, and they're shorting a security that's broadly defined under 3A11 of the Exchange Act, and that security in this example is trading on a non-US exchange, but it still doesn't matter. So this is an example. This is a really good question that it really amplifies the whole issue that the SEC is taking a very broad and expansive approach to the scope of this rule. They're very interested in your short positions. So if you meet those threshold requirements under B, because this is not a doesn't sound like it's a reporting company. If it's a non-US, it could be, but if it's a non-US, private company, let's say, it would be under the threshold B. If you meet that threshold, then you're going to have information that you're going to need to disclose on a monthly basis. I think what I was wrestling with a little bit when I was reading the rules, under 13F reporting on long sale positions, there's a unique interpretation that says that if you have to make a filing under 13F, then you actually have to report for the whole year, all the different, quarters. If you're subject to one quarter reporting, you have to do the other quarters in the year. And then I think at the end of the year, you can analyze whether you need to continue to report if you're below the threshold. But with Form SHO, I think you have to kind of look at your thresholds every month. So like, you might be, subject to reporting on a monthly basis for, the month of January of 2025, and you have to have that report in by February 14th of 2025. But then if your short positions don't meet the threshold, for the next month, then it looks like you don't have to report. So I'm still trying to figure out if that's the right way to look at this. It makes sense that, you don't have to report if you don't meet the thresholds, but I thought it was interesting because the Form 13F reporting, does carry over for the other 3 quarters, even if you drop down to the threshold.
And another similar question that came in, and if it's a Hong Kong issued shares are short and not US ADRs, any difference from what you just said? Does that change your answer any?
I think no. I think if you're subject to the reporting requirements, and those non-US securities are going to be subject to the threshold requirements to analyze. So same thing with with private companies or public companies. They're within the scope.
Okay. Here's one for you, Robin. What's the likelihood of an issuer moving from one category of reporting to the other category, non-reporting? How often do you think we need to cross-reference reporting information to issuers to see what threshold they fall?
I mean, I really think it matters. The size of your shop really would probably be indicative of how the threshold relates to you, because if you have a very small shop and you're shorting, very small positions, and you probably have nothing, not as much to worry about, which is why, and when Dan was describing the reporting in one month and not the others, which is why I think a compliant solution is actually, coding this into your guideline as a soft restriction is probably a very wise way to ensure, because if your short position is very, very close to the edge, you may not want to report that, so you would back off on trading that. The soft restriction would allow you to know where you are at any point in time, because you could run your compliance reports on those rules. And I think it just depends. A very, very large shop is obviously going to have a much bigger short position than a small shop. So I think it really just depends on your conviction, your strategy, conviction, and the size of your portfolios.
Yeah, and it's interesting to me too. In Threshold A, the SEC was entertaining comments from people that said, well, $10 million of reportable securities, the reporting company threshold in A, $10 million is too low. It should be 100 million, and the SEC said no, they wanted to take the 10 million, which is a much lower approach. Or if the monthly average gross position at the close of the regular trading hours is a percentage of the shares outstanding in that equity security of 2.5% or more. So the reporting company, you have one threshold. The non-reporting, it's just 500,000 or more at the close of regular trading hours on any settlement date. during any calendar month. So it's possible that you could get, captured by the reporting requirement by threshold B, because, you're shorting some things that are maybe privately, placed, or, you have short positions and things that are, not reporting companies under threshold A. So I think, once the firm kind of does this analysis, they're going to determine whether they have to report. And it's just important not to stop at threshold A, the reporting company threshold. You also have to go to that next level, because it's just as important for the triggers.
Okay, I have a
Mhm.
toss-up question. So whoever wants to take it, be my guest, and this is about what's reportable. How do you work out the foreign exchange rate for non-reporting issuer threshold for non-US denominated securities?
Mhm. That's a really good operational question. I think it might be, the conversion to USD. I think you got to convert to USD, because that's the threshold that they're using, but I really don't know.
Yeah, so you would have to take in the foreign exchange rate to create that, conversion to
Mhm.
USD, which would come in with your market data, which, again, just adds to the complexity of getting the calculation correct.
Yeah.
Mhm.
Well, that's why I said it was a toss-up. Okay. So let's, I guess we can move on to the next slide. Well, we were already there almost, but so from the presentation so far, is there anything else you guys want to, and I know you did this a lot, but anything else we want to reinforce for our audience that maybe a little nuance that they need to be aware of?
Mhm. Well, I think there's a tendency to think of the official 13F list, which is applicable only to the 13F long positions, as the guide for determining your short positions. And I think, that's a classic mistake here, because the scope of the rule and covers much more than just the official list. Some commentators wanted an actual, form SHO list. They thought that would be a helpful way to proceed. Just tell us which ones you want, and we'll go out and find them. But the SEC rejected that and adopted the more broader, reporting requirement. So I just think, as far as your operations and your compliance go, don't wait too long to get a draft of this exposure to really understand your true short position.
Dan,
Exactly.
Dan, since you're the lawyer on the panel here, I'm gonna do you see, if you could put on your Oracle hat, and I know the timeline is quickly approaching, but do you see any legal challenges to this new rule?
It's a good question. There've been a lot of legal challenges to the SEC and Gary Gensler's rulemaking, especially with respect to private funds. And we've seen some pushback on rules. I don't see the same thing happening with the 13F2 requirement. Although, it does give me a little pause, because November is when we're going to first see the template electronically, through the Edgar system. So, if there are any flaws or electronic, issues or technological issues with that process, there might be a delay. But, the form is so tiny, right? It's not a big form. It's not like it should pose such a huge burden. It's just, you want to basically be able to address the nuances of the form. And once you do that, I think, it probably will be a seamless filing. And, it's just that, monthly filings are kind of, unique for managers. Usually you see filings that are on the quarter, which gives you a little bit of time. Form ADVs, they're annual filers. You have to do other than annual amendments sometimes, but we're used to dealing with quarterly filings. We're used to dealing with annual filings. You've got some filers, that that have to do reporting for, you know, if they own 5% or more of a security, or if they're, you know, 10% or more, those are more time-sensitive filings, and that go through Edgar. And, you know, compliance officers and operational and trading personnel really have to, you know, be on the ball and be timely with those requirements. So I kind of think of this Form SHO as being that type of filing where it's a monthly, and you really got to keep up with your calculations. You can't do that monthly filing, you know, for the first time and look at it, you know, on the due date. You've got to really have it in place, almost on a real-time basis.
Yeah, you know, Dan, it's funny because I remember back when I was on the institution side of things, our compliance department, you know, they would be frantic when they had to do a 13F file, right? You know, and that's, you know, once a quarter, you know, 45 days out. And, you know, it was all hands on deck to get that filing done. And now we're moving to a monthly filing. So, you know, you can see the angst when people bring this up, if they're, you know, in the business of shorting.
Right.
Well, again, from my perspective, that's where, you know, technology enablement helps a lot with this file and other filings. And, you know, the landscape is changing, right? Who knows, with AI and everything else, this may become, you know, easier, let's say. But at least initially through this period, to your point, Anna, about the angst, I do feel there's some angst in the industry, and you know that's why we're having this webinar to hopefully clear up some of that anxiety for people that have attended today, and that people that will be able to you know, download the webinar at a future date. This has been fun. Hopefully it's been helpful to the audience that's out there, and the contact information is now on your screen. And you know, we're happy to take any follow-up calls, reach out to anyone on the contact list. And unless there are any other tidbits with that, I would say thank you for joining, and give you a couple minutes back.
Thank you.
Thank you.
Thanks, everyone. Thanks for participating.
Take care.
Bye-bye.
Bye-bye.